Hi there, Serial Trader here. Let's have a look at the major US indices. And okay, so the hourly chart on SPX, we're still working this potentially as a deep retracement, and the key level to hold to stay bearish, at least short term, is 29.5486. So if I go in closer here on the 15-minute price chart from that 29.54 level that we put in more than a week ago, it looks like we do have still that 1, 2, 3, 4, 5 down potentially in place. So that initial impulse wave down. So far, I mean, it's gone extremely deep, this upward retracement, but so far it is still valid. As you know, if it's a second wave, for instance, and we're getting ready for a smaller degree third wave down, wave 2 can retrace up to 100% of wave 1. It just can't go beyond that. So anything, technically speaking, up to 29.5486 here on SPX, as long as it failed right at or below that level, this is an acceptable wave 2. But at this point, we've gone beyond the 786 retracement of this initial leg down. So that's a little concerning to stay bearish. But again, not officially a violation until we get to that 29.5486 level and go beyond that. Then this is no longer wave 2. It's no longer an internal retracement, and we're doing another wave up to a higher high. But hasn't happened yet. And just looking at this 15-minute chart, you can see we got our little impulse up for A, 3-wave decline in B, and now if I even go in on these subdivisions, so if we're working a wave C for a larger 2 and we're going to fail right away, we can certainly count 5 non-overlapping waves here. So let me just illustrate that. Kind of something like this. And let's get the degree down. One more. So you can see you can still count 5 within C for 2. But I mean, bottom line is this has to fail real soon here and not take out that 29.5486. Otherwise, something else is going on. So I just wanted to show those smaller details on the 15-minute chart. But yeah, again, on the hourly chart, assuming we can fail here essentially right away and start breaking down, and a good sign of breaking down, again, we'll be taking out this lower trend line of this price channel that we've been in since we made that low at 27.97, so just below 2800. It'll be a good sign to take out this lower trend line. Certainly this previous little support level, as it's labeled here, as a B wave. Take out this level, 28.4765. That'd be a good sign that we're rolling over and perhaps finally starting something more substantial to the downside. But again, it's so tight right now. No, one thing I like, okay, whenever you get this close to taking out a key level, obviously the probability of taking out goes up the closer you get to it. But so does the risk-reward ratio increase, because since we're so close to that key level of being taken out, if you go short, essentially at current levels, what are you, 20 or so points away? Okay, less than 30 points away from violation. So that's an extremely good risk-reward setup. Okay, so let me just demonstrate that visually here. If we do a short position, now you can't technically short the SPX cash index, but we can use the futures or an ETF or whatever you fancy. But assuming we do this, and let's just, for simplicity, assume that we just went short basically at the close there on Friday. So right now, just to go test that previous low, never mind break down to new lows, you'd be getting an over 7-to-1 risk-reward ratio just because your stop is so tight between the current level and the violation level there at 29.54. So let's just pretend we go down in a nice 5-wave sequence to make our initial A wave down, something like that. And we have that stop in place. So that's like a 17-to-1 risk-reward ratio. So the probability, basically here, this is the kind of setup that, you know, higher chance of getting stopped out. But if you don't get stopped out, man, the risk-reward ratio is good. So you take a few of these trades, only one of them has to work out to make up for all the little stop outs you get. Again, though, you are more in danger of being stopped out when your stop is this tight and you're that close to a key level. So me, I didn't take any position on as far as shorting futures on Friday. I'll be looking Sunday night when the futures open, assuming they don't take out that key level on the futures, which I believe. Let's see here. Oh, hang on. Which I believe was 29.65. So that's the key level on the futures to be short against. And again, on the futures, that's about 35 points away from where we closed there on the extended session before the weekend started. So yeah, I'll be looking at this Sunday night. As long as we don't take out that 29.65 here on ES, I'll be looking for a short futures entry with obviously a tight stop and potentially large reward if we can actually peak out here and roll over. But that's, and also I'm still holding the July SPX 2500 strike puts, and I'll close those if we take out on Monday. If we take out the SPX high there at 29.5486, if we take that out, I'll close those and then just kind of sit back and see what the market wants to do. This is a nice setup, but if it gets violated here, if it doesn't work out, then I don't have a clear picture of what's going on, and I'll have to just wait for another pattern to kind of develop and potentially another trade setup to form. But this is the current trade setup. We got a deep retrace, we got a tight stop entering your current levels, but for it to work, it just has to start working almost immediately. I mean, as soon as Sunday evening when the futures open to Monday's regular session, to me it either takes out the highs or we start rolling over. It's pretty much as simple as that. Okay, so that's what I wanted to go through on SPX. We'll go to the Thinkorswim Candlestick chart and looking at the daily candles. So we do have a small gap up here on Friday. So Thursday's high was 29.0192. Friday's low was 29.0288. So we have a very small gap that's unfilled. That's good because gaps usually like to get filled. So that's a good reason to roll over here, if only to fill the gap. Never mind all the other stuff we're looking at. But again, if we do take out that high at 29.5486, there's another gap up here that I think is a very good target, and that would be 29.9983, so just about 3,000. And now that 200-day simple moving average is also sitting right at 3,001.97, so essentially the exact same level as filling that gap. So if we do take out that high, I think you get another good 50-point move off of that. So, I mean, if you're bold and you're not worried about this thing really just tanking on you, taking out this 29.54 high, that probably sets you up for at least a 50-point move up in short order, which could be a nice little short-term trade. Not sure if I'd take it, but the target is there. Take out that key level, and you're probably looking at least a 50-point pop or so before you get up to this next area of technical resistance and confluence. Okay, one thing I'll point out, you can just see this clear divergence here on the stochastic oscillator as price just slightly made higher highs, and even now we haven't actually made a higher high yet, but we're in danger of doing so. You can see that the stochastic oscillator continually makes lower highs. So this is telling you the trend is very, very exhausted to the upside. Large downside risk, minimal upside potential, just based on that large divergence there. So there's that. Now on the weekly candlestick, this is kind of something to grab your attention. On the SPX Weekly Candle, we have a huge bullish engulfing candlestick engulfing these two prior weeks' real bodies. So here we have the hanging man candle, potentially a bearish reversal candle. And then again here we have the inverted hammer / bearish engulfing, another bearish reversal candle. Now this week we've had a bullish engulfing candle engulfing those two prior weeks' bodies, real bodies. So this is a strong buy signal on the weekly. Obviously if it works, it's going to take out this 29.54 high, and we're going to go up there and at least touch that 3,000 level or more. So you do have this weekly buy signal, despite the bearish implications of the shorter term Elliott wave count. So it's really going to have to be which one works. Does the candlestick signal work, or does that potential Elliott wave bearish pattern work out? And you'll know, I think you'll know pretty quickly here, again within the next session or session and a half, Sunday evening into Monday's regular session. I think this is going to basically be decided here. So again, if you do have this weekly buy signal, and weekly candlestick buy signals can be powerful, as you saw down here, although we're not nearly in the same position up here as we were down there as far as market sentiment, but still, you do have this weekly bullish engulfing to act on if we take out that high. So that would add a little confidence to at least a short-term bullish trade if we take out the high. But again, that's a big if. Okay, just thought I'd point that out because, sometimes you get these mixed messages. We do not have a bearish candlestick on the weekly. If we did, it would certainly add confidence to the Elliott count, but in this case, we have a conflict. So we'll have to see which one proves correct. All right. That's what I wanted to go through there on SPX. Now on the Dow Jones Industrial Average, same idea. This looks like a little 1, 2, and then we're looking for a 3 down, but key level to hold on the Dow is 24,764.77. And if I just go here to the 10-minute on the Dow, you don't have to be an expert at Elliott to kind of see what's going on here short term. This really looks like a clean 5-wave sequence down into the low. This looks like a corrective 3-wave advance to a lower high. And ideally, we peak out soon and roll over. It's just that simple as far as the Elliott count goes. And if we don't, then we're going higher, and that count is invalidated. And what we'll be looking for here on a target for the Dow, if we do take out that high, there's a lower gap here on the Dow to fill, and let's see where that would come into play. 25,226.62. So where would that put us? Roughly 1,000 points higher from where we currently are, because we're around 24,331. So yeah, a little less than 1,000 points on the Dow to the upside to fill that gap. The 200-day simple moving average is a little higher up there on the Dow. That'd be a little over 2,000 points higher. So a less attainable upside target if we do take out the high. But again, you see this large bearish divergence developing on the oscillator for the Dow here as well. Let me just try and grab that there. So as the Dow slightly made a higher high, he certainly didn't make a higher high on this oscillator, kind of telling you weakening momentum of this uptrend. So an exhaustive kind of move here. Now another interesting pattern that kind of grabs my attention. It's not a Elliott pattern, but it is a potential technical pattern. And that's this potential for a little head and shoulders top here on the Dow, where this would be kind of the left shoulder, then we got our head, we're working our right shoulder here, and then we'd want to roll over to confirm. And taking out the neckline would kind of be something like this for the head and shoulders pattern. I would basically draw the neckline kind of something like that. So that's something you could watch for as well. Now on the weekly chart of the Dow, weekly chart, we have a bullish engulfing candlestick on the weekly there as well. So again, if we take out the high and confirm this weekly buy signal, we could certainly head higher and look to close that gap, which is about 1,000 points higher from current levels. So yeah, again, just the mixed message between the weekly signal there on the candle and the shorter term Elliott count. Let's just see which one proves to be valid early this coming week. Okay, now on the Nasdaq Composite, this continues to diverge from the other two indices, and I have this retracement from the overall all-time high to that March low in the Nasdaq. So we're just about at the 786 retracement. So a very deep retracement here on the Nasdaq, and we also look like a lot more like a 5-wave move off the bottom. It looks more like a 5-wave impulse wave off the bottom. So I'm less confident when the Nasdaq starts pulling back here that we're actually going to go down and make a new low, being that it does look like such a clear 5-wave move up. Whereas the other two indices, you can still argue, just look like an ABC up, a 3-wave move up from the lows. But nonetheless, you could still get a pretty deep retracement from current levels on the Nasdaq. So let's just say we peak out in relative short order here. Let's just, for the sake of illustration, say that the peak is in as of Friday's close. I'm not saying it is, but let's just pretend. Even just a 38.2% retrace, which would be a very minor retracement before we make another, move up there and for another impulse wave, that would bring us down to 8,173 on the Nasdaq Comp. So about 1,000 points lower just for that very minor retracement. So even if you want to go with the most bullish scenario, that we're doing an impulse wave off the bottom, to really go along with any confidence, you got to see a decent retracement here, even on the Nasdaq. So that's just what I wanted to point out. Clearly, though, Nasdaq is making higher highs, while the other two indices so far have made a lower high. So that is a non-confirmation. Sometimes you have a non-confirmation at key moments in the market, and then one index such as the Nasdaq makes a new high, the other two don't, and then they all roll over together, or vice versa. One makes a new low and the other two don't, and you roll over to the upside and start a new trend up. So we do have that non-confirmation, assuming that the other two indices do not make a new high. So we got that. Now on the weekly, of course, the Nasdaq put in a huge bullish weekly candle and a weekly bullish engulfing candlestick. It is. And if it confirms and keeps going, I mean, this could be, who knows, we could be heading to new highs right away here on the Nasdaq. I doubt it, but we're getting closer and closer, close to that 76 retracement. So we'll have to see next week. Pretty important moment in the market as far as picking a direction here. Okay, that's what I want to go through on the Nasdaq. And on the VIX, VIX still dumping to new lows, so nothing to speak of there. VXX making new lows, again now back below the blue moving average, so nothing to speak of on VXX. Now on the VIX VVIX tool, again, this really hasn't been giving any clear signals because we have just essentially been chopping around here for, I mean, if you think about it, we've been in a fairly tight range compared to what we were for several weeks now. So basically sideways with a slightly upward bias, but largely sideways. Nonetheless, though, we still have to continue watching this because this does give off a good signal when you finally get that turn. So it's worth watching. We do have a new VVIX divergence, at least as of right now. This could certainly get canceled out on Monday if VVIX makes a new low. But for now, VVIX has made a higher low, VIX has made a lower low. So you got the VIX VVIX divergence. Assuming that holds, we'd like to see VVIX get above the red moving average, and then SPX get below the blue moving average. And then we would have another potential sell signal in place. But again, it's not there. So back to watching once again. All right, that's really all I need to point out there. Not much has changed as far as the bottom line message. Either we respect that high, 29.54 here on SPX, and start rolling over right away, or we take it out and basically do a little short-term bullish trade if you want to try and catch that maybe 50 point or so move up to fill the gap and touch that 200-day average, or you go short, immediately, tight stop, rolls over, great trade, or you get stopped out and, small loss, and you just go back to watching and waiting for another setup. That's where I'm at as far as the indices go. And, I mean, don't have to second guess it. Either it holds or it doesn't. Let's see what happens. Serial Trader signing off.